So these financial institutions can further be divided into two types. One is banking institutions and the other one is non-banking institutions, right? So what do you mean by banking institutions are also known as depository institutions, right? Banking institutions are also known as depository institutions. So what does it include? This depository institutions, this includes banks, this includes credit unions, right? Now, why are they called depository institutions? They are called depository institutions because they can collect money from the public, right? They can collect money from the public for any interest that they provide on the deposits made and lend this money to those people who are in need. So you all know bank accepts demand deposits and it also gives loans to others, whereas non-banking financial institutions, they cannot accept demand deposits, right? Similarly, banks can issue checks. Banks have the authority to issue checks, whereas NBFIs, non-banking financial institutions, they cannot issue checks. So what are non-banking NBFIs, non-banking institutions or non-depository institutions? Insurance companies, right? Insurance companies, mutual funds, brokerage companies, all of them fall into this category, right? Um, uh, they cannot accept demand deposits from the public. They are not authorized to issue checks, but they can sell their financial products to the customers. That they can do, right? Now, these financial institutions can further be classified into three categories, right? What are those three categories? Regulatory institutions, intermediates, and non-intermediates. Okay? Regulatory institutions, intermediates, and non-intermediates. What are regulatory institutions? Regulatory institutions are those institutions that regulate the financial markets like RBI, IRDA, SEBI, right? What does RBI do? RBI regulates the functioning of all commercial banks in India. Similarly, IRDA regulates the functioning of all insurance companies in India. SEBI regulates the functioning of stock exchange and stock market players, right? So all of them are called as regulatory bodies. And what are intermediates? All these commercial banks, right? All the commercial banks that provide loan and other financial institutions, all of them are called as intermediates, like SBI, Union Bank, right? Canara Bank. These are all intermediates. And non-intermediates are those institutions that provide financial aid to corporate customers. That means they don't target individual customers, but they target companies, corporate customers like NABARD, SIDBI, right? IFCI. These are all examples of non-intermediates, right? Now let us look at or let us try to understand what are development banks, right? What are development banks? So development banks are also known as special industrial financial institutions. Okay, development banks are also known as special industrial financial institutions. These banks were mostly established after World War II, both in developed as well as developing countries. And just like everywhere else, these development banks in India also, what is their primary function? They're primarily responsible for accelerating the economic development of the country. So, how are they different from commercial banks? See, unlike other commercial banks, development banks, they do not mobilize savings. Instead, what do? They invest these resources in a very productive and efficient manner. Okay, and these banks are expert financial bodies, and they perform dual functions, two functions. What are those dual functions of these development banks? One is granting medium and long-term finance to private entrepreneurs. That is their first function. And the second one is performing promotional roles for the economic development of the country. So they are also involved in promoting the economic development of the country, right? And then development banks are responsible to provide medium and long-term finances to industrial as well as agricultural sector, right? Both industrial as well as agricultural sectors. And some of the most popular development banks in India are IDBI, right? IDBI stands for Industrial Development Bank of India. Then Exim Bank, the Export Import Bank of India, right? These are some of the most popular development banks. In fact, ICICI Bank that we have, that is a apart. Before that, it was only ICICI, right? So Industrial Credit and Investment Corporation Bank of India. So before ICICI Bank came into picture, what ICICI used to do is they used to provide loans to small, medium, and big businesses. So that was also a development bank then. So these development banks, they're nothing but they're financial institutions that provide long-term funds, right? They provide long-term funds to those companies which are in heavy need of capital, like capital-intensive investments or capital-intensive companies, we call them, no? For a longer period of time, whenever these companies need funds, development banks provide them, right? And because they are they are lending money for irrigation systems or urban infrastructure, mining, heavy industries. You cannot expect high yields, high return from them. So their lending yield usually is very, very low. It yields very low rate of return, because see, the primary purpose there is not to make money. The primary purpose is not profit. Profit is not the primary motive. Development of the economy, that is the primary motive, right? So they are also known as development finance institutions, or they're also called as long-term lending institutions, right? So these banks, they lend at low and stable rates so as to promote long-term investments along with social benefits, right? So that is the dual function there. See, usually these development banks don't provide short-term loans. They usually provide medium and long-term credit lending facilities, right? And the main objective of these development banks is to serve the public and not make profits, like I told you, right? And they provide financial assistance to both public as well as private sector institutions. Okay. So coming to the importance of development banks, what is the importance of development banks? Development bank lays the foundation for industrial growth and development in the country. It helps industries meet their long-term capital needs. Apart from, and it not just helps big industries, even the small and medium sectors are also helped by these development banks. And these development banks, they undertake a lot of promotional activities, right? They promote industrial growth. They try to create employment opportunities. And most of these development banks, they promote self-employment projects, right? Self-employment is very, very essential for a highly populated country like India, where unemployment is a major problem. So these development banks overcome that problem by promoting self-employment projects. And if there are any sick units, right? If there is any business which has been providing employment to a large section of the population, but is into losses for quite some time. So what these development banks do is these development banks come into the picture, and they try to revive these sick units. And by doing all these things, what they're indirectly also doing is, see, these development banks are also indirectly contributing to the capital market of the country, right? They try to generate more exports, right? And thereby they are promoting, import substitution. And Another feature of development bank is development bank extends the risk capital. Right, development bank is extending the risk capital. Because of this, what is happening? Science and technology is being promoted. Science and technology is being promoted. Right. See, there are different types of development banks in India. Right. SIDBI, for example, SIDBI is one development bank. SIDBI stands for Small Industries Development Bank of India. This SIDBI was established in 1990 under an act of the Parliament. SIDBI was a wholly owned subsidiary of IDBI. Right? Its headquarters is in Lucknow. Now, what does SIDBI do? SIDBI takes initiatives for technical upgradation and modernization of the existing units. Right? So those units which are already existing for quite some time and they need funds for upgrading their technology or modernizing their unit, SIDBI takes up, SIDBI helps such kind of units, right? And the focus of SIDBI mostly is small scale industries, right? So they expand the channels for marketing the small scale industry products in both domestic as well as international markets. So if there is a small scale industry, it wants to promote its products in the overseas markets also. And if SIDBI feels that they really do have the potential, then SIDBI supports that as well. Right? Then it promotes employment generating opportunities, particularly, in semi-urban areas. See, urbanization is a huge problem in India today, right? People are moving from rural areas to urban areas because of lack of employment opportunities there, which is leading to a number of problems, right? In order to avoid that, what SIDBI does is SIDBI tries to encourage these small sector units which are set up in rural or semi-urban areas, so that they provide employment opportunities to the local population, right? So what this would do is this would try to prevent migration of people to urban areas. But see, one of the major reason why people migrate from their native places or their hometowns to urban areas is lack of employment opportunities. So if those employment opportunities are provided to them at their native place, there could be a significant drop in the migration percentage. Right. Next, coming to next after SIDBI, it is NABARD. Right? What does NABARD stand for? NABARD stands for National Bank for Agriculture and Rural Development. Right? NABARD is also a very important development bank in India. NABARD was also created by the Special Act of the Parliament. And what is the primary focus of NABARD? The primary focus of NABARD is to uplift rural India, to promote or to help rural India by increasing the credit flow for promotion of agriculture and non-farm sector. Not just agriculture, even the non-farm sector in rural areas, even that is supported by NABARD. NABARD's headquarters is in Mumbai, right? So NABARD takes care of cottage industries, small and village industries, and all those other rural establishments. So some of the important roles that are taken by NABARD are it undertakes monitoring and evaluating projects. So whatever projects it refinances, it also closely monitors and evaluates them. And one important thing that NABARD does is, see, there could be some financial institutions, local financial institutions that finance the rural sector. NABARD provides finance to these financial institutions also. So, in other words, NABARD refinances the financial institutions that finance the rural sector. Right? It regulates those institutions that provide financial assistance to the rural economy. It provides training. It provides training facilities to those institutions that assist the rural development. Right? And all these cooperative banks and regional rural banks all of them are regulated by NABARD. Right? So the first development bank that we saw was SIDBI, then NABARD, then there is something called as Exim Bank. Right? Exim Bank stands for Export Import Bank of India. Exim Bank is Export Import Bank of India. So Exim Bank is a financial institution that is created by an act of the Parliament, that the Export Import Bank of India Act of 1981. So it is a public sector financial institution. The main aim of this bank is to finance the Indian exports, right? Whichever company or whichever unit is exporting, right? Exim Bank finances that. And you know how important exports are for a country. Exports generate foreign exchange for the country, which is very, very important, right? Exim Bank also, extends term loans for foreign trade. Those institutions that are into foreign trade, Exim Bank also provides term loans to them, right? In simple words, we can say that the main aim of Exim Bank is to finance, facilitate, and promote foreign trade in India. Right? And some of the functions of Exim Bank, if we have to look at the functions of Exim Bank, the functions of Exim Bank are to finance imports and exports of goods and services in India, as well as in the developing countries in the world. Right? It provides a lease for exports and imports for machinery and equipment. It finances joint ventures in the foreign countries. So if any Indian company wants to enter into a joint venture with some other foreign counterpart, and they need funds for it, Exim Bank will provide funds for that as well, right? It also undertakes limited merchant banking operations like, issue of shares, debentures, bonds or stocks of only those Indian companies that are involved in the international trade, right? And all those businesses that are into import and export, Exim Bank provides technical, financial, and even administrative support also, right? So these are some of the functions of Exim Bank. Coming to the National Housing Bank. Now this National Housing Bank, it is a state-owned bank, right? And the regulatory authority and this National Housing Bank was established in 1987, again under a special act of the Parliament called as the National Housing Bank Act, right? The headquarters of National Housing Bank is in New Delhi, and National Housing Bank is responsible for regulating and refinancing the social housing activities, like even including research also, right? So basically, NHB was established to promote private real estate acquisition, right? So this institution further aims to provide inclusive expansion with stability in the housing finance sector. So one of the major activities of NHB is extending financial assistance to those various eligible bodies in the housing sector. How does it provide? By two means it provides. One is through refinance and the other one is through direct finance. Right? Refinance and direct finance. So the National Housing Bank, what it does is it extends refinancing to all these various primary lending firms like scheduled banks or housing finance corporation or cooperative sector bodies. It gives them funds to support their housing sector loans, right? That is through refinancing. Now NHB also is into direct finance, right? So it offers direct finance for land development, integrated land development, and shelter projects of those public agencies in respect of land development and shelter projects, right? Then IFCI, Industrial Financial Corporation of India, right? This is the first specialized financial institution that provides term finances to large businesses in India, right? And the primary objective of IFCI is to provide long and medium term financial offerings to those large scale businesses uh, where ordinary banks which are not catered by the ordinary banks, or such finance cannot be raised through issue of shares. In such situations, IFCI comes into picture, right? So some of the functions of IFCI are setting up a new industrial undertaking, expansion and diversification of existing industrial businesses, right? Renovation and modernization of existing businesses, meeting the working capital needs of the industries. These are all the functions of IFCI, right? Next, if we have to look at the classification of banks, right? There are various types of classifications, right? Banks can be classified into commercials and cooperative banks. So what are commercial banks? Commercial banks operate their business for a profit purpose, right? Whereas the basis of operation for a cooperative bank is on cooperative lines, that is service to its members, service to the overall society as such. So in comparison to a commercial bank, cooperative banks provide a higher rate of interest, right? And these commercial banks also, again, can be categorized into two types, right? Scheduled commercial banks, non-scheduled commercial banks. So what is a scheduled commercial bank? A scheduled bank is a bank that has been included in the second schedule of the RBI Act 1934, right? So there is one section, one schedule in the RBI Act. Then all these scheduled banks, their names are listed in that, right? And this a scheduled bank has to be a corporation, right? It has to be an incorporated company, and it has its paid up capital should not be less than 500 crores, right? So and obviously non-scheduled banks are all those banks whose name is not included in that second schedule. But these non-scheduled banks also have to put some reserve requirements like SLR and CLR, CRR and all those things. They are also required to maintain reserve requirements with RBI as per the norms of the RBI, right? So I told you banks are of two types, commercial banks and cooperative banks. Commercial banks again are of two types, scheduled and non-scheduled. Similarly, cooperative banks are also again of two types, right? Urban cooperative banks and rural cooperative banks, right? So urban cooperative banks are also known as primary cooperative banks. So what they do is they help the communities, the localities, the workplace groups, and these banks are usually set up in urban or semi-urban areas, and their main customers are usually small borrowers and businesses. So these urban cooperative banks, they are classified into again scheduled, non-scheduled categories. And then coming to public sector banks. So what are these public sector banks? These public sector banks are controlled by the state government, by the government, right? So SBI, Bank, Union Bank of India, Canara Bank, these are all controlled by the government. So they are all known as public sector banks. So most of these nationalized banks were nationalized in 69 and again in 1980. And the government owns more than 51% stake in all of these banks, all these public sector banks, right? And private sector banks, whether are owned by private individuals or private business houses or groups, where the government does not own more than 51% of the stake. So ICICI Bank, HDFC Bank, Axis Bank, Yes Bank, all these are examples of private sector banks. Apart from these two, public and private sector banks, you also have foreign banks. So these foreign banks are established in India. They're providing services in India, but they are owned by foreign entities, right? So Citibank, right? HSBC Bank, Deutsche Bank, these are all examples of foreign banks. The regional rural banks. What these regional rural banks do is, these regional rural banks, their primary goal is developing the rural economy. The primary goal is developing the rural economy by providing credit and other facilities, particularly to the small and marginal farmers, agricultural laborers, rural artisans, and small entrepreneurs in villages, right? And mostly they lend money for the purpose of developing agriculture, trade, commerce, industry, and other productive activities. Just a second. And other productive activities in rural areas. So the national government, these regional rural banks are also, government has a majority stake in these regional rural banks, right? And one requirement on these regional rural banks is they are required to distribute 75% of their funding to priority sectors, right? And NABARD, we just discussed about NABARD. NABARD supervises these regional rural banks. Okay. Then one Mudra Bank. There is something called as Mudra Bank. Mudra stands for Micro Units Growth and Refinance Agency Limited. Now, this is a government-owned financial agency that is dedicated to the development and refinancing of micro enterprises, right? So, Mudra Limited is usually a non-banking finance company. It has been set up as a subsidiary of SIDBI, and the primary goal of this Mudra Bank is to provide funding to non-corporate sector, like in informal sector, these small businesses in rural and urban areas, small manufacturing units, shopkeepers, etc. They can approach Mudra Bank. And Mudra Bank's loan limit is 10 lakhs. Beyond that, they cannot lend money. Okay, so that is about Mudra Bank. And then you have something called as payment banks also. Payment banks are of recent origin. In 2015, right? RBI has approved application for payment bank licenses, and the amount of deposits that these payment banks can receive from one individual are rupees 1 lakh, right? Post offices, like post offices are payment banks today. And these payment banks only demand deposits would be accepted by them, right? Coming to small finance, that is about financial institutions, right? These are the various financial institutions. So I told you the financial system of any country consists of 4 components. The first one is financial institutions that we have already discussed. Next, let us look at the next component, important component of the financial system of a country, financial assets. So what are these financial assets? So what are these financial assets? These financial assets are products that are traded in the financial markets. So based on the different requirements and needs of the credit seeker, the securities in the market also differ from each other. So some important financial assets that we can discuss is call money, right? So what is call money? When a loan is granted for one day and it is repaid on the second day, then it is called as a call money. And no collateral securities are required for this kind of transaction. So that is call money. Next one is notice money. So when a loan is granted for more than one day and for less than 14 days, it is called as notice money. So no collateral securities are required for this kind of transaction also. So for call money also you don't require collateral securities. For notice money also you don't require collateral securities. Then coming to term loan, right? So when the maturity period of a deposit is more than 14 days, it is called as term money. And treasury bills. Treasury bills are also known as T-bills, right? They are government bonds or debt securities with a maturity period of less than 1 year. So if you are buying a treasury bill, it means that you're actually lending money to the government, right? Then you have something called a certificate of deposits. So what is certificate of deposit? Certificate of deposit is an electronically generated form. Okay, it is a dematerialized form for funds that are deposited in the bank for a specific period of time. Then commercial paper. Commercial paper is an unsecured short-term debt instrument that is issued by companies, corporations. Right? So these are the various financial instruments. Coming to the third component of the financial system, that is financial services. So what are the various financial services? See, the purpose of financial service is to cater for a person with borrowing, selling, or purchasing securities, allowing payments and settlement, lending, and borrowing. So these services, they help in the management of funds as the money is invested efficiently now, and it also helps to get the required funds. These services are provided by the assets management and liability management companies as they get the required funds, and it also these financial services also make sure that they are efficiently invested. Right? And some of the financial services in India, common financial services that we see are banking services, right? So all the services provided by banks, like granting a loan, depositing the money, issuing debit cards, issuing credit cards, opening a bank account, all of that fall under banking services. And then coming to insurance services. So, services like issuing of insurance, selling policies, insurance undertaking, brokerages, all of that is a part of insurance services, right? Next, investment services, right? Investment services mostly, includes asset management services, right? That is about investment services. Then foreign exchange services. So exchange of currency, foreign exchange, all of this are a part of foreign exchange services. So these are financial services. Coming to the fourth component of the financial system. What is the fourth component of the financial system? Financial markets, right? So what exactly do we mean by market? In economics terminology, markets refers to a system where buyers and sellers. So market is not exactly a place, a physical place as such, but market is any system where buyers and sellers interact with each other and they participate in the trading of money, bonds, shares, or other assets. Right? So the financial market, it can be further divided into 4 types. Right? Financial markets can be classified into 4 types: capital markets, money markets, foreign exchange markets, and credit markets. Okay, capital markets, money markets, foreign exchange markets, and credit markets. A capital market, it is designed to finance the long-term investment. Okay, it is designed to finance the long-term investment. The capital market, it deals with transactions which are taking place in the market for a period of over 1 year, right? And this capital market, it can be further divided into 3 categories. So corporate securities market, government securities market, and long-term loan market. So you see corporate security markets, see buying of shares, buying and selling of shares, right? All that falls under the category of corporate securities market. And we just now discussed about treasury bills or T-bills, right? So transactions relating to treasury bills or T-bills, that falls under government securities market. Okay, so that is about capital market. Next, coming to money market. Money market, it is mostly dominated by government, banks, and other large institutions. So this money market is usually authorized for small term investments only. It is like, it is a like a wholesale debt market which usually works on low risk and highly liquid instruments. The money market can further be divided into two types: organized money market and unorganized money market, right? We can call it as organized money market and unorganized money market. Now, this organized sector or organized money market, this comes under the direct purview of RBI, right? So it includes banking and other sub-markets like, commercial banks, um, you know, um, commercial bills, T-bills, certificate of deposit, commercial papers, all of that falls under organized sector. Coming to our unorganized sector consists of indigenous bankers, the local money lenders, these, local non-banking financial institutions, all that falls under unorganized sector, right? So that is about money market. Then foreign exchange market. So see, one of the most developed markets across the world is the foreign exchange market. This market deals with the requirements that are related to multiple currencies. So transfer of funds from one country to another country based on some foreign currency note, foreign currency denomination, or foreign currency rates, all that is facilitated in the foreign exchange market, right? Next, coming to credit market. So any market where short-term and long-term loans are granted to individuals or organizations by various banks and financial and non-financial institutions, it is called credit market. See, we just now discussed about SIDBI, NABARD, IFCA, and all that, right? So they provide loans to organizations and individuals. So all that falls under credit market, right? Now, let us try to understand so far we've discussed the components of the financial system. Now, let us look at the importance of financial system, right? See, financial system of any country is a very important, is a vital part of its economy, right? It acts as a connecting link between savers, investors. It manages risk. It supports economic growth. But some of the very important um, functions of financial system are: the first one, capital formation, right? We will actually discuss about capital formation later in greater detail. But for now, one of the very important function of financial system is capital formation. So what financial system does is it helps form capital by channeling the funds from the household savings or individual investors to investors, people who need money, to business houses, right? And the next point is financial system also helps the economy grow by facilitating trade, investments, and innovations. And risk management also is a very important function of financial system. It helps manage risk by providing a variety of financial instruments. Okay. It also helps allocate resources efficiently by channeling capital from surplus holders to those who need it. And financial system also helps maintain economic stability by providing liquidity and capital. Okay. Then one thing that we need to when we're discussing about components of financial system, one point that I missed out is currency. Currency is also a very important component of financial system. See, it is the exchange medium in a financial system. It is like the heart of the financial system. What currency does is, currency helps facilitate trade, and it allows customers and businesses to do transaction, right? So if there was no common currency, Trade and business would be very, very difficult. We would have to go back to the old system of barter system, right? So in India, it is RBI that controls the economic supply of money. It keeps the inflation in check and the currency stable. So India's currency system, it is very, very crucial for both domestic as well as global trade. Right? And okay, that is about financial system. How to improve the financial system of a country? How can the financial system of a country be improved? See, the financial system of any country provides several advantages. It has a number of benefits for the economy, but it also has its share of problems. Now, these problems have to be managed for the economy to grow and remain sustainable in the long run, right? So, how can the financial system be improved? The first one is better regulation, right? So, strict regulatory supervision is required, is very essential to maintain financial stability and to avoid fraud. So, governments and central banks, they need to continue to update the regulatory frameworks according to the change in finance markets. SEBI and RBI, SEBI Stock Security Exchange Board of India, Reserve Bank of India, they regulate the financial markets in India. So if these, they are already regulating, but these regulatory agencies need to be strengthened further. And all financial institutions should be compelled to comply with best practices. Then our financial system would be even more stronger, right? So things like, strict capital requirements, enhanced disclosures, better supervision, all these will help regulators ensure that, these financial institutions are able to function in a safe and sound way, right? Then financial literacy. Financial literacy is very, very important. So increasing financial literacy is vital to enable individuals and companies to make informed decisions on how to save, how to invest, how to borrow, all these things, right? What financial education does is financial education helps minimize the chances of financial mismanagement, and it enhances the use of financial markets. For example, India's financial literacy movement was taken up through National Center for Financial Education. What it does is it attempts to educate the general public on good financial habits, about the need to save, invest, and the need to manage debt at appropriate levels. All these things, right? Then technological innovations are also very, very important. So the adoption of financial technology, what it can do is it can reshape the financial system to provide more accessibility, efficiency, and safety in the operation of services, right? So these emerging technologies, including blockchain, mobile banking, digital payments, all of that, what it can do is it can enable greater financial accessibility, particularly for developing economies such as our country, right? So encouraging the integration of technology into financial services, it can help to improve the efficiency of payment systems. It can reduce transaction costs, and it can also expand the access of these financial products even to remote areas, which is very, very essential. Right? Now let us look at the history of the Indian financial system or the evolution of Indian financial system, right? The pre-independence era, that is, till 1947. This period was a mixed bag for the rebirth of the modern Indian financial system, right? During this time, financial system in India was highly informal, with very basic, very elementary financial market structures. So financial intermediaries were just taking shape at that point of time, and capital flow for long-term financing was was almost non-existent at that point of time. That means if big businesses needed funds, there was no way that there was any financial institution which would help them with that. But what happened after independence is, after independence, the leadership at that point of time, they favored socialist ideas, and they undertook an approach of planned economic development, right? And what this approach needed was, this approach needed the distribution of financial resources under the government control. And this need for control resulted in the public ownership of financial institutions. Like, it all began with establishment of RBI. RBI was established in 1935. It was later nationalized in 1949. And in 1956, the Imperial Bank, which was established before independence, Imperial Bank became the State Bank of India, right? And there were a lot of insurance companies at that point of time. They were also called as provident societies. So all these, there were like, more than 200 insurance companies and provident societies. All these were nationalized and put together under one umbrella called as the LIC, Life Insurance Company of Life Insurance Corporation, Life Insurance Company of India. And again in the year 1969, 4 more banks were nationalized. 1980 also, again 6 more banks were nationalized. And in 1964, Unit Trust of India came into existence, right? Unit Trust of India came into existence. And this Unit Trust of India, it gave birth to the mutual fund industry in the country, right? General Insurance Corporation was established in 1972. So other than life insurance, all those insurances came under this category, general insurance. It was established in the year 1972. Right? And a lot of other financial institutions like Development Finance Institution, IFCI was established. State finance corporations were established at the state level, right? And one of the most significant event in this development finance space was the establishment of ICICI, right? It was an initiative of Government of India and World Bank. So ICICI stood for the Industrial Credit and Investment Corporation Limited, right? Now, during this time, the Indian financial system, it saw significant development in terms of compliance frameworks, in terms of operational policy, legal structures. All these, in fact, strengthen the financial system further, but at a slower pace. Then there was this Capital Issue Act 1947 that was passed. The Companies Act 1956 was passed. Security Contract Act 1956 was passed. MRTP Act 1970. FERA Act 1973. All these acts were passed. And all these resulted in the financial system taking diversified structures, Then, see, this pre-1991, the state-owned Indian financial system, it had some drawbacks, like, for efficient sourcing, management, and distribution of capital. They had a flawed configuration. It was basically a DFI-dominated structure where sourcing of fund was either state or sponsor dependent, rather than institutionalizing of public saving. So the emphasis was more on the government, the state giving funds rather than mobilizing savings from the general public. So what happened because of this? Financing scope got very, very limited. See, to what extent can government give funds? To what extent can these few institutions give funds? So apart from this restricting of the financing scope, it also gave rise to a number of disorders, like the political industrial nexus, the lopsided capital structure of invested companies. Like companies used to have a very high debt to equity. There was very lesser promoter risk, right? And the probability of default was very, very high. But after 1991, we saw a liberal market economy, right? There was like liberalization of the economy. What this did is this led to this adoption of market-led approach. What it did is it reduced the state control over the financial system. So financial system started getting slowly detached from the government control, state control, and government started playing the role of a facilitator or a regulator rather than the owner of these banks or financial intermediaries. So this change started reorganization of the financial system at a very, very fundamental level. And since the government was distancing itself, what they did was they established some regulators. They established some bodies that they felt could regulate these financial institutions. So SEBI was established, IRDA was established, right? So they thought these bodies could regulate these financial activities. Then National Stock Exchange was established in 1992. Stockholding Corporation, right? All of them came into existence in 2000. Then, screen-based trading started happening in the year 1992. NSE introduced the screen-based trading. Then dematerialization of shares began. Shares moved from physical form to an electronic form, online form, right? Insurance and mutual fund sectors also grew very well after 1991. In fact, we can say that post-1991 period was especially very good for these two sectors. Various national and foreign entities, they began to participate in the mutual fund sector. And even insurance sector also. So under the purview of IRDA, insurance sector became much more disciplined and dynamic, and there was a lot of participation of national and foreign players, right? So that is how financial system in India has evolved, right? Now let us try to look at the financial system and the economic development, right? So the financial system ensures that all interest rate stabilization, right? Interest rate stabilization is one very important contribution of financial system to the economic development of a country. And then trade to help to trade and commerce, right? International trade, then attracting capital, all these, right? Infrastructure development. These are all the different roles that this financial system played in order to provide or in order to contribute to the economic development. Employment creation. Employment creation also was a very big advantage of a financial system. So how does it generate employment creation? See, what financial system does is it provides capital to entrepreneurs who want to start a business. And when these businesses come into existence, they directly or indirectly require services of a lot of people. And as a result of this, a lot of employment is generated. Right? So these are the various ways in which financial system of a country helps the economic development of that particular country. The next topic that we need to look at is capital formation. So what exactly is capital formation? Right? If you look at it from a narrow perspective, one second. So, okay, what does capital formation mean? Capital formation means increasing the stock of real capital, right? Which helps in raising the level of production of goods and services. So, therefore, the essence of the process of capital formation is a diversion of a part of society's currently available resources to the possible and expansion of consumable output in future. So, in this concept of capital formation can also be extended to human capital formation. In fact, it is not only real physical assets and financial assets like shares, bonds, currency notes, and bank deposits that are included in capital formation as they increase the productive capacity of an economy. Right? So the meaning of capital formation is that society does not apply the whole of its productive activity to the needs and desires of immediate consumption, but it directs a part of it to make capital goods, tools and instruments, machines and transport facilities, plant and equipment. So all the various forms of real capital that can directly increase the efficiency of productive effort. So domestic capital formation not only aids in construction, equipment, and inventories within the country, but it also all the other expenditure that is expected or that is necessary to sustain output at that particular level, that also is known as capital formation. And capital formation has a very, very significant role to play as far as economic development is concerned, right? So capital formation or capital accumulation, that is regarded as a key factor in economic development of an economy. So this, the vicious circle of poverty that can be easily be broken in underdeveloped countries through capital formation. So it is capital formation that accelerates the pace of development with further utilization of available resources. So what capital formation does is, capital formation helps in the formation of a sound infrastructure, right? Especially in its initial stages, what capital formation does is it promotes the establishment of social overheads, like basic capital goods. And the next one is use of roundabout methods of production. So in a backward country, the process of capital formation makes possible for use of complex methods of production, which makes the division in different stages. Right? So that leads to further growth in production. Next one is maximum utilization of natural resources. So in underdeveloped countries, there is an increase in the capacity of risk taking by capital formation, by which fresh natural resources are made available. Right? Then proper use of human capital formation. See, what capital formation does is, capital formation plays an extraordinary role in the qualitative development of human resources, not just quantitative. So, education, training, health, socio-economic security, freedom, welfare facilities. Capital is needed for all of that. So labor force, it needs up-to-date implements and it needs instruments in sufficient quality, so that with the increase of population, there will also be an optimum increase in production, and that increased labor is easily absorbed. Right? Another benefit or an advantage that we can say, this higher rate of capital formation. What does it mean in a country? It means a higher rate of economic growth. So the rate of capital formation or accumulation is very low in comparison to advanced country. So in poor and underdeveloped countries, the rate of capital formation usually varies between 1 to 5%. But if it exceeds 20%, that is considered to be a very high rate. In developed countries, that is usually the percentage. In some of the developed countries, it is even more than 20% also. Okay. Then capital formation leads to agricultural and industrial development. Right? So modern agricultural and industrial development, it needs adequate funds for adoption of latest mechanized techniques, input and setting of different heavy or light industries. So without sufficient capital at its disposal, what capital formation does is it leads to lower rate of development. So therefore, the development of both these sectors, right, agricultural sector or industrial sector, the development of both the sectors is not possible without adequate capital formation. And finally, capital formation also leads to increase in national income, right? How does it do that? See, capital formation improves the conditions and methods for production of a country. So therefore, there is an increase in national income and per capita income whenever there is an increase in capital formation, right? So this leads to increase in quantity of production, which leads to again rise in national income. Okay, so the rate of growth and quantity of national income necessarily depends on the rate of capital formation. So increase in national income is possible only by proper adoption of different means of production and productive use. Now, coming to another important aspect of capital formation is expansion of economic activities. As there is an increase in the rate of capital formation, productivity increases quickly and the available capital is utilized in a more profitable and extensive way. In this way, complicated techniques and methods are utilized for the economy. Right? And what capital formation also does is it reduces a country's dependence on foreign capital. See what happens in underdeveloped countries. This process of capital formation, it increases dependence on internal resources and domestic savings, because of which the dependence on foreign capital is reduced. Economic development, what it does is it leaves that burden of foreign capital, and see, therefore, to give that interest on foreign capital and bear expenses of that foreign aspect becomes a very, very burden to the on the economy. So this gives a major setback to our internal savings. Right? This leads to improvement and enhancement um, uh, in the way a country functions. So a country can attain self-sufficiency and it can get rid of foreign capital dependence by the way of capital formation, right? So, but how does how does the process of capital formation function? It mainly happens in three stages. The first one is creation of savings. Second one is mobilization of savings. And the third one is investment of savings, right? So the first and the foremost thing is creation. Savings must be created. That means there must be an increase in the volume of real savings. People must be encouraged. People must be encouraged to save. They must be encouraged to sacrifice some current consumption, right? Only then capital formation is possible. See, for example, if a community saves nothing and consumes whatever it produces, right? So, for instance, if a community saves nothing and it consumes whatever it produces, no new capital will come into existence, right? So, how will production of consumer goods happen in the future? All the capital assets, if they are used now itself, there would be no production of capital goods in the future. So, therefore, it is essential that people should save from the present consumption. So, this creation of savings, it depends on the power to save and the will to save and the facility to save also. Sometimes, I want to save, but I don't know where to save, or I don't have proper mechanisms to save. The next one is mobilization of savings, right? So this process is also very, very important. The savings must be mobilized and converted into investable funds. And for this purpose, the existence of banking and other financial institutions is must. So, even if you want to encourage even the people in the remotest areas of the country, there must be existence of banks, there must be existence of financial institutions there. So these banking facilities, they provide uh, considerable help uh, to promote high rate of mobilization. Then the final stage of capital creation is investment of saving into capital. Now, this requires a class of efficient, dynamic, daring, and skilled entrepreneurs. Right? Now, an able and efficient entrepreneur is one who's ready to make investments for the production of capital goods. So, both savings and investments are crucial for capital accumulation. Right? The next topic that we need to discuss is financial intermediation. So, what exactly is a financial intermediary, or who is a financial intermediary? So, a financial intermediary is an entity that acts as a middleman between two parties in a financial transaction, such as a commercial bank or an investment bank, a mutual fund or a pension fund. So, these financial intermediaries, they offer a number of benefits to the average consumer, like safety, liquidity, or economies of scale, all these things. So, although in certain areas such as investing, advances in technology, uh, though they might appear to threaten to eliminate the financial intermediary, uh, uh, these intermediaries, they play a very major role in creating efficient markets and lowering the cost of doing business. So there are a number of financial intermediaries, like mutual funds. They provide active management of capital pool by the shareholders, the fund managers, right? Different types of financial intermediaries, underwriters, then merchant bankers. These are all different types of financial intermediaries, right? So some of the benefits of these financial intermediaries are, like, through a financial intermediary, savers can pool their funds, and it can enable them to make large investments, right? So that is the need for financial intermediation, right? So that is the topics that we need to discuss for today, right? So the topics that we discussed are what is the structure of financial system, what is the history of financial system in India, or the evolution of financial system in India, what are the functions of financial systems, right? What is the process of capital formation, what is the need for financial intermediaries, right? What are the reforms that have taken place in the insurance sector? These are some of the topics that we have discussed today. The remaining topics we'll discuss in tomorrow's class. Tomorrow also, same time, we have our class.